Hey there, CRNAs. Welcome back to Money Moves for CRNAs. If you're a 1099 nurse anesthetist and want to hold on to more of the money you earn, you're in the right place. This podcast comes to you twice a month. Always short, simple, and designed to make your money work smarter. And just a quick note, this podcast is for educational purposes only. For personalized advice, talk with a qualified tax or financial advisor. In our last episode, we broke down the One Big Beautiful Bill Act, from lower tax brackets and bigger deductions to better child credits, and even more charitable write-offs. All great news for CRNAs looking for extra breathing room. Today, we're kicking off part 1 of a 2-part series on how CRNAs can use an S-Corp to turn taxes into opportunity. We'll show you why timing and strategy matter so much when it comes to taxes, and how smart planning now can give you more freedom, flexibility, and financial control down the road. Now, here's your host, Randy Larkin, CPA from Atlanta Tax Planner.
Hi, welcome back. Let me ask you something. When you hear the word taxes, what comes to mind? Stress? Headaches? Maybe a big fat check to the IRS. Well, what if I told you taxes don't always have to be painful with the right plan? You can actually use taxes to your advantage. Yep. Instead of just handing money to Uncle Sam, you can turn taxes into opportunities. Today, we're talking about how CRNAs, especially those working as 1099s through an S-Corp, can use smart tax plays to build wealth and even retire tax-free. We'll cover 3 big strategies. 1. Delay taxes during your big $350,000 earning years by loading up your solo 401k. 2. Convert to Roth IRAs when you slow down and your income drops to, let's say, $180,000, and grab the senior deduction if you qualify. 3. Use recessions to lock in tax-free growth at a discount. Sound good? Let's dive in. Play 1. Delay taxes in your big years. Picture this. You're working full-time, pulling in $350,000 through your S-Corp. Great income. But the IRS is standing there with a fork and a knife. Here's your play. Max out your solo 401k with traditional contributions. Since you're both the employee and the employer, you can save on both sides. As the employee, you can put in up to $23,000 in 2025 or $30,500 if you're 50 plus. As the employer, your S-Corp can add up to 25% of your W-2 wages. Together, that's as much as $69,000 a year, or $76,500 if you're age 50 or older. And the best part, it goes in before taxes. So if you earn $350,000 and stash $60,000 in your solo 401k, the IRS only taxes you on $290,000. You can save thousands of dollars in just 1 year. With an S-Corp, you also get to split your pay between W-2 wages and distributions, which helps cut self-employment tax. The trick is balancing your W-2 high enough to maximize your 401k, but not so high that you drown in payroll taxes. That's why having a CPA who understands CRNAs is a game changer. So during those high income years, your best move is clear. Load up your solo 401k. Delay those taxes now while you're in the top brackets. Play 2. Convert when it's cheap. Fast forward a few years. You're tired of all the shifts and scale back. Maybe you're making $180,000 part-time instead of $350,000. Still great money, but now your tax bracket is much lower. This is when you flip the switch. Instead of putting more into traditional accounts, you start doing Roth conversions. Here's how it works. You move money from your traditional solo 401k into a Roth IRA. You'll pay taxes on the amount you move, but since you're in a lower bracket, those taxes cost you less. It's like buying gas when it's $3 a gallon instead of $5. And here's the bonus. If you're 65 or older, the government gives you a senior deduction. That's an extra $6,000 if you're single, or $12,000 if you're married, on top of your standard deduction. So imagine this. You're 66 years old, making $180,000 part-time. You take the standard deduction plus the senior bonus. That lowers your taxable income by over $28,000 if married. That leaves plenty of room to convert another $30,000 to $40,000 from traditional to Roth without jumping into a higher tax bracket. But here's the catch. The senior deduction only lasts from 2025 through 2028. After that, it's gone. So if you're in your mid-60s during those years, this is your golden window. Use it or lose it.
And there you have it, the first two plays in your CRNA tax strategy playbook. You've seen how smarter timing and planning can help you keep more of what you earn and start building real wealth with purpose. But we're not done yet. In Part 2, we'll dive into one more powerful move, a strategy that can supercharge your tax-free growth and help you make the most of market changes. Trust me, you won't want to miss it. If you found this helpful, be sure to follow or subscribe so you never miss future episodes packed with smart tax strategies and financial insights. And don't forget to share it with a fellow CRNA who could use a little tax clarity too. Until next time, work smart, save more, and take control of your money. Music licensed from premiumbeat.com. Under license number 7394047.